Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today we've got a bit of a double whammy. For those of you who don't know, I'm a popular investor on eToro. I run a portfolio there. So we're going to talk about my latest position that I've added to the portfolio and some changes in different positions and different weightings. And I'm also going to talk a little bit about the arbitrage book that I run and how we've got an amazing opportunity that I executed overnight. So if you're interested in a possible 10x on straight equity, and if you're interested in a 12-fold potential annualized return, I'm going to show you how I have a decent chance of achieving that with the options market and with the equity of Castor Maritime Inc. If you haven't already liked and subscribed to the channel, I'd greatly appreciate you doing so. Bit of a long one today. We've got a lot to talk about. This is actually the position that I am most excited about recently. So stick around. I think you're really going to like this one a lot. So some facts on the company. We always go through this. Revenue expected to come in at 132 million last 12 months, and it's growing at just an insane rate. EBITDA 67 million. Market cap at the moment is 212 million on an enterprise value of 277. Share price as a close was $2.35. 94.6 million shares outstanding. They've had a lot of dilution over the last 12 months, which I normally hate, but this is not a case of the management diluting for operational expenses or for SG&A or any of that rubbish. What they've done is they put in an at-the-market facility. They diluted quite a bit, yes, but they used that money to buy a lot more vessels. So very smart way of essentially positioning themselves to buy vessels at market cycle, capital cycle lows, basically scrap value. And now if the shipping industry goes where I think it will go, heading to the top of the cycle, they're going to cash in big time. Last 12 months return on capital, 13%. Net income margin is at 39% of the last 12 months. And their net debt to EBITDA is less than 1. So very healthy figures so far. I didn't want to drag it out and leave it to the end because I knew a lot of you would drop off. So I went into the options market, as I always do, to take a look to see if I can get some extra leverage on positions that I really like. I'm going to talk about the fundamentals and the technicals. Here, I had to say this. So I haven't put in the amount that I actually ordered. I've just done it per one contract, okay? So I can keep some sort of anonymity. But let's just say you were interested in this position and you weren't sure on the technical movements whether this was a good time to get in or whether there might be a better time later down the track or whatever the case may be. So let's take a look. What would it cost for an in-the-money put? Okay, so if I were to short a put option in the money at $5. Okay, so the 5 strike out 20th of May. When I entered, I think it had about 38 days left. So I like to get in around the 40 to 45 days if I'm shorting puts to take advantage of the theta. And so you would receive a premium of $275 per contract at the $5 strike. And maximum risk of would be a total loss of 225 should the stock go to zero. I'll start to branch into more of the options explanations later. If you don't know what a put option is, it's the right to sell an option. So if I'm on the other side of the transaction and I'm underwriting the contract, this would mean that should Castor be lower than the strike price of $5 on the 20th of May, I would be obligated to buy the stock at $5. Okay, should the buyer exercise that option. Okay, so you say, well, if it's trading at $2.35, why the hell would I want to buy it at $5? Well, the answer is you get the premium. Okay, so I'm getting $2.75. So my true break-even cost, it was actually a little bit better than that. My break-even cost was $1.85. Okay, so should the option be exercised on the expiry date at 20th of May, I would have an effective entry price of $1.85 per share. Okay, so I wanted to buy the stock at $2.35, and effectively, I get the chance to collect premium, and one of two things happens. Either the stock does drop in price and the buyer decides to exercise it, in which case my effective entry is $1.85. So I've got a massive bargain on the entry. And remember, this is something I wanted to buy in any case. Or let's say the share price shoots higher, and obviously in that case, the buyer of the option would not want to exercise it. So I would get to keep the premium. Okay, so for every one contract that I wrote, which represents 100 underlying shares, I'd receive $275 of cold hard cash. So if you overlay that, my max return over the max risk, and that risk is not a true reflection, because it's saying this is what I would stand to lose if the stock went to zero, which I don't believe is going to happen given the balance sheet, which we're going to look at in a moment. It works out to be just an insane annualized return. So you'd be 12xing your money every year. Now, obviously, that's not going to happen all the time, but I just wanted to share that. Some people have been asking about not just the eToro. eToro is just another thing that I do. This is where I spend most of my time in the derivatives markets. Anyway, let's move on to some basic overview of the company. It's a shipping company, okay? Normally that's a terrible business in which to be in, but every now and then you do get these cyclical bull markets, and it's a boom or bust type of industry. This company is different. They're dangerous words, but this actually has a fundamentally different business model. It's more, think of it as a royalty company. So they charter out the vessels as opposed to taking on a lot of the operational considerations and therefore the operational expenses. So they have a lot less of the downside and a hell of a lot of the upside in the overall macroeconomic environment. They're in both tankers and dry bulk ocean transport. So they'll transport gas and oil, which are tankers, and also dry bulk. So iron ore, bauxite, other commodities. Fleet of 29 vessels that they've been accumulating very busily over the last, I'd say, 18 months. Most of which, as I mentioned, were purchased at basically scrap prices during the bear market. Yes, they did issue a lot of shares in order to acquire them, but it's better to use that acquisition in terms of CapEx rather than just giving it to management via SG&A or OpEx or any of that sort of rubbish. So the book value as it currently stands is around $3.62 per share. So we're buying it at a very healthy discount to book. Cash on the balance sheet, $37 million. Okay, so the company is not in danger of going bankrupt anytime soon. Our investment thesis, I've broken it down a little bit differently today. I've gone to macro, meso, micro from that top down and bottom up viewpoints. So I hope that you like that. From the macro, top down, as I think everyone knows where I stand with this. Commodities just continue to look better and better, whether you look at them as a ratio to stocks or if you just look at the cyclical bull market, if you look at the supply side versus the demand, we've got it all. Inflation is a big part of that. So you've got cost push inflation and demand pull starting to happen at the same time, as well as we've had a record expansion in the M2 supply. Okay, that's the money supply in the system, the liquidity. A decoupling of manufacturing of globalization. Okay, so we've got disruption to the connectiveness of all the different nations around the world. And so there's a fair bit of chaos going on that I think will take probably a decade to sort out. We've got the meso or the mid economic view. Commodities need transport. So we're going into a bull market. There's a heap of demand for commodities. There's not a lot of supply. And so you need to be able to ship the commodities from one place to the next in terms of your imports and your exports. So the rates, okay, the people that command the shipping vessels, their rates will be able to rise substantially over time in line with the commodity bull market. And it's really interesting to see a chart of a heavy bull market in uranium in 2006-ish to 2008, and shipping actually outperformed it, which I couldn't believe when I first saw it. Undervalued versus the Baltic Dry Index. So we say, okay, well, we're interested in the shipping area, which particular company? And so this is where we'd overlay this particular company versus the BDI. The war in the Ukraine increasing shipping routes and times in transit. So it's making shipping more expensive, okay? And so that's a bad thing for most of us as consumers, but it's a good thing for the shareholders of companies such as Castor Maritime. Micro. So the company has a unique business model. It's, as I said, basically a royalty play on Baltic Dry, which is very, very interesting. We get that huge book value in terms of having lots of assets that hard assets that will benefit from inflation and the devaluation of the currency. Yet we don't have the downside of um, that annoying operational expenditure that comes with that type of business. Issued shares to increase the fleet. The investment, I believe, will really pay off as now. Imagine you've got a whole heap of ships that no one wants. Everyone gets rid of them. So these guys came in and scooped them up at scrap prices. Now, as you're seeing utilization rates increase to 99% in the case of Castor Maritime, they're starting to be able to increase the rates that they charge for these transit journeys. So it's very much like the offshore drill rig space. So we saw that rig count got destroyed, and now its utilization is coming back up, and so day rates are surging, and so we're seeing a similar thing start to happen with shipping. We're buying at a big discount to the net asset value, and there's no bankruptcy risk. So that's why I like this particular play. Okay, so as I mentioned, let's take a look at a really heavy bull market in the past, which is that of uranium. If we overlay that versus the BDI, here's how that played out. So if you think, don't get confused, it's just a ratio. Uranium, the amount of uranium needed to purchase the BDI, okay? So to purchase the share of the index, how many pounds of uranium? So if you look at this, this is just crazy. Think about how amazing the uranium run was, and then look at look at how much better that the BDI actually did during that time period. So I've drawn in an extra line here. Are we getting to that space? I don't know. I really don't know. So here we've seen uranium's bull run from the start of the year, meaning this ratio started to peg back. And could we get back up to the previous highs where shipping just goes through the roof? That would imply a massive move, nearly a six-fold move from here. We'll see. Don't know. Okay, Castor, here I've drawn in some lines. I'm starting to use more and more technicals just to eke out that little bit of extra performance, and in my derivatives fund mainly, more so than the eToro. Okay, I'll always use fundamentals. I'm not relying on technicals. I'm just trying to use them to complement. So these lines here I've drawn in terms of the lower highs and then lower lows until that starts to converge. Okay, so then you're getting higher lows, lower highs, and what we want to see is on this line, we want to see higher lows being put in, so there's a real support price under support level underneath the share price. If we look at a percentage, the price has been whacked recently over the last year or so, so we're able to get in at a fairly handy discount. Here we're looking at past history. So if we go back to where we were, this was at a share price originally of $68. They went through a heap of dilution, don't forget, so it's not going to be quite the same. However, as unpopular as that was, we then saw this volume start to come in where they used that to put on their ATM and buy a heap of vessels, and then it's just been a very unpopular stock since. So losing about 95% of its original value. Yes, they diluted a heap, but if you look at this potentially forming a double bottom, we see eventually the company no longer is going to, it doesn't have the volume for the ATM dilution, it doesn't have the support for that. I think what you'll see is that the company has already issued some debt, which is a good way to start to finance now because they're actually making money. They've got strong cash flows. As the market starts to see that and they get more confident that they're not going to further dilute the shareholders, we'll see this start to rip on the back of market multiple re-rating and cash flows surging. CTRM versus the BDI as a whole. Okay, so here's where we're at with that. So it's not super cheap in terms of as cheap as it was back here in October, but nor is it as expensive. Some projections. So if we're looking out into the end of the next year, this, I really think you'll agree, this is very, very conservative, the way that I've analyzed this. But you guys can come to your own conclusions. This is just my opinion, obviously, as is everything on the channel. So the book value, it'll be somewhere around $3.65. What is an appropriate price to book? So if you look at previous highs, it's been as high as 4. I've used a pretty conservative valuation there of 1.8 using some of the competitors and the industry median. The implied price of that would be 657. I've done the same thing with the EBITDA and the earnings, but what I have done is not used last year's numbers and carry them forward. I have used the end of the quarter from the quarterly report and obviously times that by 4 to give an annualized projection. Okay, so that's why these here have asterisks. They're an annualized projection. And then again, I think you'd agree these are pretty conservative multiples. I think we could easily see potentially double these multiples. Okay, any which way you dice it, if you take an evenly weighted average there, we've got a target price somewhere in the near future of $6.36, which is a 270% upside implied. Okay, so my opinion is we could get very close to that in a very short time frame, and so I'm positioning both for income. If it doesn't go my way, I'll scoop up the shares even cheaper, and if it starts to rip, well, then I'll be making a very handy premium in the near term. Okay, so from the quarterly reports, let's take a look. So here's the vessels revenue being brought in. There's your op income, your net income, earnings, okay, and then projecting that into the future times it by 4. Further down here, I want to draw to your attention 2 things. First is the utilization, 99%. Okay, so the guys are chockers. What happens when you're consistently at 99% utilization? You start to increase your rates. So this isn't where they were at the end of last year. The rates have come up to $25,000 a day. Their latest contracts, if you read the company announcements, they're at 25,000, not 22,000. And if you look at 2019, average rates for dry bulk was around 34,000. So that suggests a huge upside just if we get back to 2019 levels. Okay, if we get back to 2008 levels, holy moly, who knows what can happen. Here are the vessels. That's at their, I don't believe that's even a fair valuation because that's when they bought them at more or less scrap value. So you can see the changes. Look at the change in their book value from year to year in terms of their assets, and then look at the rate of that growth is quite substantial. Okay, anything else from the balance sheet? Not really. This is all pretty straightforward stuff. Their assets have grown massively, and as you can see, their book value there is expanding as we go along. Here, I think is the, it's obviously a possibility, but it's nothing is certain. So my opinion is, well, what if we have these sorts of day rates, much like we used for Transocean and some of the other rig stocks? It's a function of the vessels and their day rates, their utilization rates, and how much cash flow will that bring in to the shareholder, and what sort of multiple is the market willing to pay. So this is a very simple table. You could do one at home and put your own assumptions in, and obviously that would change the price. So I've used multiples here of 5, 6, and 7. What that's saying is a multiple of the net income. So I haven't used EBITDA, I've used net income to shareholders. I have assumed that there's no more dilution. Okay, so if there's some further dilution, this line here would need to be adjusted. But as you can see, if we take our base case here of 29 vessels at a day rate of 25,000, 99% utilization rate gives us an annual revenue of 260, call it 262 million. Okay, which is basically the enterprise value at the moment. Enterprise value is 277 million, which is crazy. The net income of that, if you use their current margin, which is, I use 37%, and that could obviously, they could improve on that. But what if that would be around $97 million. If we apply a 5x multiple to that, we get 484 million in terms of net income divided by the shares. And you're looking at a share price then, an implied share price valuation of about $5.12, which is obviously a double from where we're at, a little bit over a double. And then obviously you can change your day rates. So if we have a more bullish case of $35,000 a day rates, and we keep a good 99% utilization rate, following the same format, but applying a 7x multiple, assuming no further dilution again, we could be looking at about $10 of implied valuation. And so, it's very interesting. That could easily be a 5-bagger or a 10-bagger. And that's the way that I'm playing it in terms of having a position for the eToro fund. And obviously, I'm really going hard in terms of getting extra leverage through the options market for my derivatives book. So at the end of all that, the verdict is, I personally, it's just my opinion, I'm buying the stock. Okay, it's got low debt to EBITDA. It has got plenty of margin of safety. It's trading at a massive discount to net asset value. It's got sales growth has been extreme over the last few years, albeit COVID has played a part of the base effects. Strong margins, free cash flow growth, doesn't have a history of share buybacks. It could do that. It could take that cash and start to buy back stock, in which case watch out, because the valuation will go through the roof, or they might pay a dividend, or they might continue to buy up more vessels, and as long as the commodities bull market continues to shine. So I'm actually looking to weight this closer to 5% assets under management. I've trimmed positions in some of the other stocks that in which we've made a profit, and I'm reducing the number of overall holdings and going into some more higher conviction plays. Thank you for watching. If you haven't already liked and subscribed, greatly appreciate you doing that. And of course, if you want to add us to your watch list on eToro, or if you want to copy the portfolio so that you mimic the gains from my and the performance, so gains or losses from my hard work, you can simply download the app and add some funds and copy the portfolio. Having said that, guys, none of this is advice. It's just my opinion. I'm not a financial advisor. I don't know your particular circumstances. I'm only telling you what I think in terms of what my opinion is and what I'm doing. Okay, so I back it up in terms of what I'm doing, but it's not advice. What I do might not be appropriate for you, and vice versa. So you do need to take responsibility for your own decisions and the consequences that they may bring. Having said that, I hope that you enjoy the video and that you got a bit out of it. If you have any questions, drop me a comment. Greatly appreciate all of the comments that I've been getting in these videos.